And action. Okay, Business Administration 123, Financial Management. I know we went over this really quickly, so that's why I rewrote the technical analysis and I recorded it for you so that you can review it. Let's go through price patterns. Again, there's technical analysis and there's fundamental analysis. Technical analysis is looking at the charts, the chart patterns, to be able to determine the opportunities for trading. Fundamental analysis basically looks at aggregate supply and aggregate demand factors and uses fundamental analysis to be able to predict the movements in prices. We will go through the fundamental analysis for you, and fundamental analysis can be used in valuing individual stocks, but fundamental analysis is basically economic analysis using supply and demand factors to be able to determine price movements in the stocks, bonds, oil, gold, currency. It's basically economics, microeconomics 101. So review your microeconomics, and this will be, the fundamental analysis will be more clear. But the book doesn't go through, which I think is extremely important, technical analysis, using charts and price movements to be able to identify opportunities to be able to trade that index, either be a stock index, a bond index, an oil index, a gold index, or even a currency index. So the basic price movements are almost the same across all prices. Prices behave in similar patterns. So the technical analysis is being able to just identify price patterns and see where the opportunities are to either buy or sell those investments. And you can use the derivatives, and I'll get into the derivative trades later, but I want you to be able to conduct both fundamental analysis and technical analysis, and to be able to use both of them to confirm your trades. So first is, here's a typical price pattern. The price is moving up, and obviously prices don't move straight up. They move up and down as information comes in on the prices. So the prices move up, that's price momentum, that's upward momentum as the stock price moves up, or bond price, or whatever price you're looking at. So there's this jagged upward movement. Then usually the price will peak at some point and be constrained at the top by what is called a resistance line. The stock will trade for oil or whatever the price is. We usually trade in some kind of trading range and will be bounded by its resistance line and its support line, and will trade within this range or in what is called technically a channel. Usually some information comes out, supply or demand, in regards to the price that will have some either upward or downward effect on the price. In this case, there is a upward effect. As the price index or the price of the indexes move up and break out or break through the resistance line, it then starts to move up. And as you can see, it broke out and then hit a peak before it started to come back down. That becomes the new resistance line, and then the breakout point becomes the support line. So now you have a leg up in the market. It's now range bound again, trading within a channel sideways, and then the price of the investment or the index is just waiting for new information to come to drive it up or down. And again, in this case, you can see that the index broke out again to the upside and kept going. So basically this was, when you see the price or the index start to bottom, that is what is called a bottoming pattern. it is bottoming, the bottoming pattern that is creating the support. So that's basically the patterns, and you can use this analysis when you're looking at the stock indices, the bond indices, the oil indices, the gold indices, the foreign exchange indices, when you're looking at the exchange traded funds, pricing movements, individual stock price movements, the bond indices, bond funds, oil exchange traded funds with oil prices as a portfolio trader. You can look at those. You can look at gold companies. So this technical analysis can be applied across everything that you're looking at from a time series standpoint based on the prices. So let's dig in a little bit more on oil prices. So we're tracking oil prices, and this is the oil price index that reflects the price of a barrel of oil. In this case, it's West Texas Intermediate Crude, or WTI. So this is very high quality oil. It's in high demand across the globe. And that's the index that we are using, the price index that we are using to track oil prices. So if you look back in time in the 80s, oil prices traded, at around $20 a barrel for years and years and years. It wasn't until really the mid-80s through to the 2000 period that there was some upward movement, but it was very linear in the appreciation rate, of the oil price index due to increasing demand and limited supply. So naturally the prices would go up. It wasn't really until 2000 that you saw a spike in the oil price index, well beyond its where it was trading historically. So when the prices go up very rapidly, that's called a run to the upside in the prices. So the prices are running up, and they continue to go up very quickly, and they did go very quickly from $20 all the way up to $110 per barrel. 113 is where they peaked. When they peaked, that is called a technical top, or it is a technical top with forming a new resistance line. Once it peaked, oil traded around $100 to $90 for years. But it wasn't until recently that you saw a sell-off in oil prices and a downward trend in prices. You started to see the downward trend start to break through some support lines. Then the oil prices started to trade within a range or a channel, but was creating a support. So it looks like now that the new support for oil is $40 a barrel. I don't think that we've had enough time in trading to be able to see where the resistance line is. So let's just use $90, because that's where it traded for quite some time. So $90 resistance line, $40 is the new support. So the question becomes, are oil prices going to trade sideways for quite some time? Are they going to be range bound? Will the $90 continue to be the ceiling or the resistance line? Will $40 be the new support line? Or based on a lot of the things that we had talked about in class, OPEC continuing to increase production, Iraq producing, but a lot better than it was after the war, Iran negotiating the nuclear deal, which will allow them to export oil. You have Venezuela and other Latin American countries that continue to export oil. We have fracking here in the Midwest and upper Northeast in the United States. We now export more oil than we import. And then fuel efficiency and just productivity gains in consumption of oil, and really the concern for carbon footprint and greenhouse gases and global warming. So if you take those factors into consideration, it really looks like the barrel of oil will probably fall as opposed to rise. So if the barrel of oil falls below $40, it is breaking out to the downside. So the question becomes, will $30 be the next support, or will they continue to break out and break down, and will we ever see another $20 barrel of oil? If we think that that's our view, we can make money by writing forward contracts and futures contracts. We can make money by buying put options on futures contracts and writing call options on futures contracts. So we can make money when prices go up. We can make money when prices go down. We can make money when prices go sideways. And I'll get more into the trades and the derivatives later on. Thank you very much.